oof, is it possible that 2023 could be even worse than 2022? Well, Goldman Sachs says so. Citi Bank has 3 scenarios for us, which we'll be going through here. We'll talk a little bit about what CFOs are thinking, what are consumers doing, and, oh man, what do some of the charts tell us we might be facing? Well, let's get into this because in one of the scenarios, we see a negative 90% number, and it's just not that good. Okay. Anyway, let's get right into it. So, first, Goldman Sachs believes that the bear market is not over. In fact, they expect that the stock market, the S&P 500, will essentially be flat all the way through to 2023's end. That's because they believe that the S&P 500 will end at 4,000 in 2023. If you see here, we are presently within 1% of that level. And that's not very optimistic of an outlook for 2023. They cite the rapid deterioration of economic conditions. They suggest that this process is just now beginning and that potentially the bottoming of earnings per shares for companies isn't even in sight. That we might not actually see the bottom of earnings per share for companies until potentially late in 2023 or early 2024. Now, do keep in mind that in other research, Goldman Sachs analysts have suggested that the stock market tends to bottom about 6 months before the bottom of an earnings recession, as the bottom of earnings per share. But the question is, where is that bottom? If the bottoms of earnings per share for companies doesn't actually come around until, let's say, Easter 2024, then we might not actually bottom out until November of 2023. So that's leading to a lot of doom and gloom. So much so that when you look at what CFOs surveyed by Deloitte say, 39%, that's almost 4 out of 10, actually expect stagflation in 2023. That means no growth and high inflation. Yikes. 46% of those chief financial officers expect a recession in 2023, which, gosh, at this point, seems like it's already kind of baked in the cake. But then again, you look at the stock market on the daily, it's like, nope, nothing's baked in the cake. It just seems to get worse and worse. And then when you try to compare January of 2020 to what we're seeing now, you're actually seeing some serious changes in consumer behavior as well. Just consider this. If we look at consumers' personal savings rates and compare it to consumers' credit card spending, or I should say credit card debt rates, look at the inversion of these curves. It's not usually what we think of when we think of an inversion, but look at this. You've got the green line representing the personal savings rate falling to 3.1%. That's the lowest level on this entire chart. And this chart goes all the way back to 2016. 3.1% personal savings rate, that is the lowest level. And then when we look at total revolving debt, based on data just released from the Federal Reserve, what do we have? We have, oh dear, much more than where we were at pre-pandemic levels. Now, if you adjust this for inflation, we're basically at the same trend line for pre-pandemic levels. So if you look at real credit spending, you see, oh, yep, we're right back at 2019 levels of credit outstanding. Not so great for the consumers. And so that's leading some to say, okay, well, are we actually starting to see any stress in the consumer yet? Because it seems like, earnings for last quarter were still pretty good, right? I mean, 63% of companies in the S&P 500 beat. So how bad could it be for consumers? Well, if you look at something that has held up really, really well, we start seeing a little bit of an inflection point. Take a look at this, a little scary. Look at this. This is a chart showing you how many people are going through TSA checkpoints. And all of the airlines have been telling us, oh, demand has been so resilient. Airbnb is like, oh, demand is so great. Everything's going great. But look at what we actually have here, which we have not yet seen. Look at that, a downtrend. If we actually try to get the angle here without the iPad correcting it, there we go. Look at that downtrend that we have on TSA travel. Now, in case you're wondering about this dip over here, that dip's about a 60% drop, just like what you could get with the courses on building your wealth, including the new Elite Hustlers course, which launches on Friday. That's this Black Friday when the largest coupon code we've ever had expires. So get into lifetime access to the programs on building your wealth. That means if we add new lectures in the future, you're locked in forever, no monthly fees, one time, you're in. And if you join before Friday, even in that Elite Hustlers course, you'll get access for the Elite Hustlers course to both live streams, the course member live stream and the Elite Hustler one. But that'll go away after Black Friday, unless you buy beforehand, where you can lock it in. Now, in case you're wondering about this dip over here, this is really your Delta variant right here, so you kind of want to take that out. And if you take that out, what you see is actually a really nice uptrend recovering out of that pandemic, right? And we were kind of trending back to what we saw in those sort of pre-COVID levels. And keep in mind, one of the reasons airports suck so much is because right now the airline industry is basically running at like 95% of what it used to be, except there's a lot more demand today, or at least we were trending in that direction until just recently here, where we've kind of started seeing a little bit of a slowdown. Now, this slowdown is a slowdown that we've seen throughout 2022, but it does make you wonder, hey, is it possible, though we've hit peak earnings for the airlines and potentially even Airbnb? Now, Vacasa will tell you, oh yeah, Airbnb has hit peak. We are seeing short-term rentals dry up. But Airbnb will tell you, don't worry, in recessions, people want to rent out other rooms in their homes, or maybe even their own home while they go on vacation. I don't know about that. But we think we'll see more growth for people renting out rooms on Airbnb than in a normal environment. I don't personally agree with that. I think there's a potential here. We could be hitting peak travel. And I think that's an important warning to watch for, because if we align peak travel potentially with a peak housing market and peak residential investments, we're going to see that consumer spend really plummet on residential investments, solar, travel, consumer discretionary spend. And where are we starting to see real cracks of consumer discretionary spend? Well, how about Target? Consider what we heard from companies at the beginning of 2022. We heard, oh, we have pricing power. We have the most PP in the world. We have pricing power all day long. We can raise prices and people keep spending, spending, spending. What are companies like Target telling us now? Well, it's not good. This is something we went through with course members this morning in more detail than we will here. But what you're seeing is consumers are showing increasing signs of stress. They're pulling back on discretionary purchases. Later in this document, they even say that people are not only pulling back on discretionary purchases, but they're running so low on money that they're even starting to have to pull back on household essentials. Sure, beauty and food are still doing well, but sales trends are softening. People are spending more money on via debt and on their credit cards, another thing Target talked about in their earnings call. We're seeing more theft and we're seeing more weakness in the last few weeks of October and the beginning of November. What is that telling you? Well, it's actually telling you, wait a minute, we just had Q3 earnings, but Target is warning about an inflection in Q4, October, right? October, November, December, that's Q4. So is it possible that we're actually about to get the really bad earnings in Q1 and Q2 for companies related to consumer spend, be it travel, discretionary spending like toys or apparel or bathing suits, like what Target's talking about? Or are we also going to see pullback on things like buying Teslas? Maybe. And that seems to be what the market is trying to parse out right now. Maybe everything is going to go in the toilet in the first half of 2023, and maybe Goldman Sachs will be right. Kind of scary. And so this is where, when we look at the Federal Reserve, we're like, hey, well, the Fed's going to relax on their hiking pace, right? And then maybe like the stock market can stabilize, right? The problem with that is there's little indication of the market actually pricing in any kind of lid here on the Federal Reserve's terminal Fed funds rate. In fact, we're knocking on doors of all-time high expectations for how high the Fed is going to hike. So you've got a Fed that's hiking extremely aggressively to levels that we have not seen in any other prior hiking cycle. Because folks, we are hiking at the fastest rate that we have seen since the 1980s. It's insane. Now, sure, we're seeing commodity prices fall. We're seeing the prices of freight start to plummet and inflect down. This is great. These are disinflationary forces that could lead to a nice amount of and falling inflation in 2023, and maybe we'll have a floor put under the stock market and we'll all be right back to the moon. Maybe. This is where we have to look at Citibank's 3 projections and potential targets, but let's just start by saying it very simply. There's a lot of uncertainty ahead. And when we inflect from what we saw at the beginning of 2022, which was everybody's got pricing power, to where we are now, nobody's got pricing power, and all of a sudden prices are falling, and all of a sudden consumers aren't spending anymore, you get a lot of fear that earnings are all going to get revised down in Q4, including at a company like Tesla. Now, I believe, or maybe hope, I'm not quite sure, that Tesla will be just fine. But what does Citibank think? All right, well, let's take a look at that. Citi gives us 3 scenarios. In one scenario, they actually think that we have so much bearish sentiment right now that everybody is expecting everything to be so frickin' bad that they're not actually considering that consumers are overall in a better place than where they used to be. Even though debt is rising, even though savings rates are low, we might be in a situation where inflation falls very quickly and this coming recession ends up being a soft and shallow recession, and we end up getting a short squeeze to the upside and we rebound nicely. That's one idea for the S&P 500 and markets. Of course, then there's the counter argument that Citibank released, which is, well, or we have to actually get through the real recession. That the real recession hasn't happened yet. That quantitative tightening has barely just started to affect our markets. And that potentially some stocks being down over 90% is just the beginning. Carvana being down over 97%. And really, it's not the inverting of the yield curve that hurts. We've got some of the deepest levels of inversion today than we've had in the last 20 years. But it's the subsequent steepening that actually leads to real pain for stocks as earnings bottom. Problem is, all recession indicators are looked at in hindsight. And the fact of the matter is, in the last 100 years, stocks have never bottomed before a recession has begun. So, this kind of makes you hope that if you're a bull, that we're already in a recession. But if we're not in a recession, then maybe that means we have another leg down, as Goldman suggests in their bearish scenario. They do, though, also have a balanced scenario. This is sort of the middle of the road scenario. And this is where they see earnings falling by at least 10% in 2023. And the share price declines that we've already seen might actually be looked at as a down payment, so to speak, towards earnings per share declines. So it's kind of like if share prices are going down, don't worry, they're going down, but we're kind of already pricing in the earnings per share pain that we're going to see. So you may as well use that 60% off coupon code down below, because why not? The worst is over. And what generally rallies first? Well, generally stocks do. Generally, an economy rallies its way out of a recession, with stocks leading the way. And there have only been 2 bear markets in the last 100 years that have taken more than 2 years to find a bottom, giving a lot of hope that maybe we'll get some green in 2023. Worst case, it's 2 years of pain, but then we're up from there. Who knows? A lot of potential pain. And this is where some folks say, hey, if we do get that sort of scenario where all of a sudden consumers really do pull back, we see those EPS declines, the Fed's potentially going to have to U-turn on either how high they're hiking rates, or they'll have to soften on their inflation target and move their 2% target maybe to something like a 3% target. Either way, Goldman Sachs and Citi give us plenty of warnings that earnings per share are coming down. We know this has been coming for probably the last 6 months. The question now is, which companies and this is the hard part, which companies are going to have the best opportunity to prove that their earnings per share already took the hit or are no longer going to take as bad of a hit as markets expect. Things won't be as bad as expected and could rebound out. Are those going to be companies like the chips, NVIDIA, AMD, TSMC? Are they going to be autos, companies like Tesla, Polestar, Ford? Not really good estimates looking out there for Ford right now, especially in that EV sector. Or is the best thing to do to just stick with oil, even though oil prices are starting to decline? On the other hand, if we look at our sectors, consumer staples, the S&P 500, they're only down 3% year to date. Could that be the place to continue to hide? Or are those consumer staples going to start getting sold off like Walmart once we rotate back into maybe a tech rally, which has fallen somewhere around 26% year to date? I don't know. But what I do know is there's a lot of pain out there, and I hope to talk to you in our course member live streams. Check out the links down below, and folks, we'll see you in the next one.